Good morning. We are going to have a quiz when we get together on Tuesday. And on Thursday of next week, homework 9 is due. Today we're going to be talking about bond investments and then extending on the ideas that we had in class last time. In class on Tuesday of this week, we talked about internal rate of return and external rate of return. And so we're going to kind of reiterate when those ideas are applicable for decision making. So any questions on the announcements before we start talking about bonds?
Are we going to be using Microsoft Excel?
You should be prepared. I don't know whether you will or whether you won't, but you should bring your computer that day and be ready to.
So if we do it on there, are we going to just do that to get the answer, or do we have to submit our actual Excel file?
You'll upload the Excel file. Yeah. In any quiz or exam where I ask you to use the computer, then you'll write your answer on the paper and then also provide your calculations. Are there any other questions? Okay. So we've already talked about bonds several weeks ago, but we're going to get into some more detail today about how to determine the value of a bond. And remember that when a company is trying to raise money, there are several different ways they can do it. A company can sell shares, which is an ownership interest in their company, and people who are shareholders are entitled to the future profits that the company may earn. Another way that a company can obtain money for a project is by going to a bank and taking out a loan. And when a company does that, of course, there's a fixed interest rate that the company has to pay back to the bank in exchange for borrowing the money. A third way for a company to raise money is by issuing bonds. And bonds are kind of like in between a loan and a stock share sale. And the reason why I say it's kind of in between is because there are some common attributes of both. A bond is similar to a stock in that individual people can participate. Whereas in the case of a loan with a bank, if you hear that IBM is getting a loan from Chase Bank, there's no way that you can participate in that transaction. But if IBM is selling bonds, then you could call up a stockbroker or a bond broker as some sort of a financial instrument trader, and you could ask to purchase that bond. And the interesting thing about it is that when the company is raising the money, they just make an announcement and they go all over the country and tell people about these bonds that they're going to be sharing. They describe their business. They give out some financial information and they talk about their customers and the contracts they have. They basically are trying to show how creditworthy they are. And they have a lot of rating agencies who look at their books and will assign them some sort of a credit rating score. And so then there's the initial sale of the bond. And most commonly bonds start at $100 per bond. And the thing about it, though, is that if you miss out on that initial sale for the bond, you can still buy it on the secondary market. And so there are some people who will buy the bond at the beginning sale that the company is having, but then they need the money before the maturity date. Because when bonds are sold, sometimes they'll have maturity dates as long as 30 years in the future. And so if you don't want to wait 30 years to get your money back, then you can just find another person to sell the bond to. And then that person, once they pay whatever value you've agreed to for the bond, now they're the ones who get to receive the interest payments over time. So the bond essentially is a contract between you and a company that not only will they pay you back the money some date in the future, but also in between now and then, they're going to give you interest payments. This is just a screenshot that I took a couple of years ago for a few bonds that were available. And you can see here is the current price of the bond. And most of these bonds at that time were pretty close to their starting price of $100 per bond. but the value on the secondary market can fluctuate quite a bit for a few reasons that we'll talk about. This is the equation that we use to identify what is the current value of a bond. And the current value of a bond isn't always it isn't always the purchase price of the bond. And the way to understand it is that when you loan a company money in the form of a bond, they're promising two different streams of income to you. They're promising those interest payments, and then they're promising the return of capital at the end of the time period, at maturity. So this is an important point, that when you own a bond, you get two different things. You get the periodic interest, and here that's R times Z. R is the bond rate, and Z is the face value. So the face value is the price that was originally paid for the bond, whether it be $100, which is a typical price. There are some bonds that are called baby bonds, and they start with a beginning value of $25 instead of $100. And in fact, bonds are sometimes denominated in amounts much larger than 100. But the thing to keep in mind is that there's the interest rate that the company agrees to pay, but that's separate from something that's called the yield. We'll talk about yield in just a moment, but here in this equation, what you'll see is that if you're trying to find out what is the bond worth now, you have to find the current value of two different factors. You have to find the current value of the interest payments and the current value of the redemption price. And so the recurring payments are an annual series here, where that's called A, or in other words, a uniform series, where you're going to be getting this same amount over and over and over again. And so what we're doing is we're finding the present value of an annual series, so P/A. And how much is that payment that we get from the company over and over and over again? It is the rate that they agreed to pay when they sold the bond multiplied by the face value, which is the initial sales price of the bond. But now inside the parentheses here, you'll notice that there's a different interest rate separate from R. And that I is the interest rate associated with the yield. And so the reason why there's a separate interest rate is that, remember, bonds don't always sell for their face value on the secondary market. Back a slide. This is showing that there were a variety of different prices, that it wasn't always the 100. You know, sometimes a company starts to get a little bit shady, and people are worried that maybe they're going to go out of business, and their bonds become a lot less valuable on the secondary market. So like if Tesla had bonds outstanding that were trading on the secondary market, they've had a lot of problems lately. In fact, their CEO, Elon Musk, just agreed that he's going to step down. And he's going to pay, I think, $20 million to the Securities and Exchange Commission. So that really made the Tesla stock seem a lot more dangerous than it otherwise would have. And so in a situation like that, where there's a lot of negative news about a company, then people aren't going to be willing to pay as much for their bonds. And that's why the yield rate is different from the face value interest rate that's being paid by the company. So the thing to know for now is just that there's two separate interest rates. And R is the rate that the company promises to pay for anybody who's holding their bonds. And that stays the same. But what changes over time is the yield. And the reason why it changes is that if you buy a bond, let's say you bought that Tesla bond, and the Tesla bond, which started at 100, if you can go out there and buy it for 75 instead of 100, then you're going to be making a lot more than just the interest rate R, because you didn't pay full price for that bond. So effectively, the yield that you receive is much higher than the bond rate that's nominally paid by the company. Okay, so that's this present value of the interest payments. The present value of the redemption price is a P/F, because that's just a single value at the end of the bond's life where they pay you back the original amount that you loaned them. Or, you know, The redemption or disposal price, it says here in parentheses, that's usually the same as Z, but in theory it could be a different amount. You know, a company could say, you know, buy the bond now and we'll give you back twice as much money in the future, or half as much money, and then hopefully the interest payments would either rise or fall based on the difference. So that is a single amount, but again you'll notice that what you discount that single amount at is the yield to know what's the value of the bond now. So sometimes the yield is known. R is always known. You know, you're always going to know what the company is willing to pay, and that's the money that comes from them directly. R is always known. Z and C are always known. But sometimes you'll be solving for the value of the bond for a given yield rate, I, but in other situations, you'll already know the value of the bond. That's the price that it's the price that it's trading for on the secondary market, and then you'd be solving for I. You'd be solving for the yield if the price is known. So we'll do different illustrations of how to solve for the value versus how to solve for the yield. Okay, so this is today's in-class exercise. It's a 10-year bond, and it pays a rate of 6% per year semi-annually. So what that means is your number of periods isn't always the same thing as the number of years. You have to look at how frequently the bond is paying interest to know the number of periods. And then the interest rate, R, is talking about the interest rate per period. So here, where it says it's 6% per year, but it's payable semi-annually, that means the bond rate per period will be different than the annual interest rate. Now, what we're trying to figure out here is how much should you pay for the bond if your goal is to get a yield of 8% per year. So before you start the calculations, let's just talk about this conceptually. So don't start your work yet. If the company is paying 6% per year, how is it possible that you could get 8% per year out of this investment? The company's only paying 6%. The selling price. It's a change in the selling price. But it's not that it rises. It's actually, you're going to be buying a bond that has a lower selling price than it originally sold for. So the way that you're making greater profits is that you're getting this $100 bond for less than $100. I guess the face value of this one is $1,000. And that is both the redemption price and the face value. All right, so the key here is that I want you to really understand that it is possible to have either a higher or a lower yield than what the company itself is paying based on the purchase price. All right, so I'm going to pause now, give you some time to crunch the numbers on this, and then we'll look at the solution. Okay, so let's just talk about breaking this problem statement down and how do you know what to put into the blanks. All right, so how many periods are there? N, the number of periods. Well, it says it's 10 years, but the interest is paid semi-annually. So that means that there are 2 periods during each year. Therefore, there's a total of 20 periods. Actually, the most common thing for bonds is that they pay out their interest quarterly. So most bonds, if they're paying quarterly, then that would mean during a 10-year time frame there would be 40 payments. All right, so you have to look at how often the interest is being paid to know the number of periods. Now the bond rate is what the company pledges to pay and they're saying 6% per year. But if it's paid on a semi-annual basis, that means there's 2 payments per year, and so the interest per period would be 0.03. What we're trying to do is we're trying to figure out what is the price that you should pay if you want to receive 8% yield per year. And so the yield rate, remember the bond rate and the yield rate are independent of each other. We're going to have to do the same thing of dividing the given yield rate of 8% by 2 so that we can get the yield rate per period. And then in the statement it says that it is redeemable at its face value of 1,000. So the face value and redemption price are the same for this bond. Okay, so we fill in the blanks, and let's see what we've got. Remember, what are the 2 components of value in a bond? There's the present value of something and the present value of a different thing. What are the 2 things? The present value of, what's this one on the right? 0.03 times 1,000 P/A. That's the present value of what? Of the annual payments, or the periodic interest that the company is giving you. So there's the value of the interest, and then what's the other component of value in a bond? It's the lump sum that you get back at the end. And so most of the time, whatever you paid for the bond is going to be given back to you at the end, that same amount. So what we're saying is, at the end of the bond's life, after 20 periods, you're going to get back 1,000. But of course, we know that 1,000, 20 periods from now, isn't worth the same thing as 1,000 now. We're trying to find what's the present value of that $1,000 payment 20 periods in the future if we're talking about an interest rate of 4% per period. You know, if we want to achieve a yield of 4%, what should we be willing to pay? And so what this first part is 1,000 times the factor of the P/F factor. This 456 and 40 cents is the present value of the return of principal. So that's how much you should be willing to pay today to get $1,000 in the future if you want to receive an effective yield of 4% per period. And then the second component, we're saying that we're getting all of these interest payments. And by the way, how much is the interest payment? Every 6 months, if you have one bond, how much is the company giving you? Every 6 months. What's the actual dollar value that they'll send you a check for? $30. 3% of 1,000. So what that means is, if you're the bondholder, they'll either deposit it into your account or they'll mail you the check. Maybe you'll have more than one bond. But what they're going to do, if we were going to draw the cash flow diagram for this investment, what it would look like is you pay the value now, you get all of these $30 payments through the 20th period, and then you get 1,000. So you get 1,000 as a lump sum, and that's a future amount. We have an annual, it's really semi-annual. A just means, remember, a uniform series. It doesn't always mean yearly basis. There can be more than yearly frequency. So $30 recurring payments. And what we're trying to figure out is how much should you pay if you want all of this to work out to an interest rate of 4% that you earned. You want to achieve 4% per period. Okay. So you can see that overall it's $864.11, because what we said is I'm willing to pay this $864.11 in order to get the 4% that I'm trying to earn out of this bond. And so even though the company themselves is only going to give me $30 each period, which equates to 3% per period, you can get 4% per period if you pay less than the face value of the bond out on the secondary market. By the same token, sometimes the yield is less than the face bond rate. And so I wanted to show you, I bought a baby bond recently, on Monday actually. I bought a baby bond, and it was B. Riley Financial. So it has this ticker symbol RILYZ. And it sells for $25.40 per bond. And so this is a baby bond that started, its value used to be, initially they were selling them for $25. And if you buy it at $25, then it's going to earn 7.5%. The 7.5% that's quoted here in the title, that is the bond rate per period. But here on this page, what you can see, if we scroll down, they're saying that the yield is only 7.38. So how is it in this case? Why is the yield less than the amount the company is willing to pay you? If the company is going to be paying 7.5% to all of its bondholders, why does this say that the yield is 7.38? Right. Yeah, this yield that they're talking about, that's the yield for someone who's buying it at $25.45. And so I paid more than the face value for the baby bond when I bought it. But that's okay, because 7.38% is a pretty good yield. I'm more than happy to get 7.38%. Now, it's not FDIC insured like a savings account is, but so that means that there's a chance these guys may not pay me. But usually the way it works is that if a company goes bankrupt, the people who own stock shares are the last in line to get any money through a bankruptcy. People who have bonds have kind of like a senior interest when a company is liquidated. So even if they go out of business, at least I'm better off than the people who own shares. But by owning this bond, I don't have a claim on the future profits. Like if they really do well and the value of the stock goes up, that doesn't benefit me. The best I can ever do is this 7.38%. Now, what if I sell the bond in the future? It's possible that that bond's price could go up, and so maybe I'd get a little extra money in addition to the interest that I've earned, get a little money for reselling the bond at a higher price. But there's a limited upside as far as that's concerned. It's unlikely that the bond price will go too much higher. There is a chance it'll go lower. So any questions about the idea of bonds? If there's one thing that students do poorly on exam 2, it's these bond calculations. This is something you really need to practice and understand. We've got other things that we need to talk about, so we can't work like several other examples just to give you more practice. But there are some problems on the homework, and of course there's examples in the textbook that I think would really be worth your time. So I'll always try and warn you of these common pitfalls when I can, and this is one where even though we've been through the example and maybe you think, I'm starting to understand it, probably it would be really worth your time to practice a few more times so that it's like impossible to miss. Okay, so we talked about the difference between face value and purchase price. And you can just think of it in terms of sometimes things go on sale. All right. There are different interest rates out there. And this is some advertisements that I took off of websites where one of them is saying that you could earn 1.11% on up to $250,000 of a deposit for a year. And then this one is saying we'll let you earn 5% and give you a $50 bonus. But then if you look up I hear someone clicking their mouse. Is someone not paying attention right now? If you're clicking your mouse, that probably means you're not listening to the lecture. So this other offer is saying that you can only deposit up to $5,000. And so sometimes you have to look at the small print to know like which to choose. And so at first glance, it seems like, wow, it's better to earn 5% than 1%. But it's not just the interest rates. So remember, this course is about decision making. And if you had some extra money that you were trying to invest, and you start looking at all of your options, it's not just the one with the highest interest rate that's going to give you the most interest. And the reason why is that it's just a small, limited investment. You can only earn that 5% interest on a $5,000 deposit. So if you had $200,000, you'd probably be better off putting it into this account, because who knows, maybe they're not paying any interest on the amounts above $5,000. So that is where we're going to talk about internal rate of return today. And generally speaking, internal rate of return analysis can't be used for comparing alternatives. The only exception to that is when the two investment amounts are the same between projects. That's the one time that you can choose which one is best based on which has the highest interest rate, is if the amounts are the same. But if the amounts are different, then internal rates of return won't tell you which project is most valuable. On the back side of the paper is a cash flow table. And let me pull that up on the screen. Okay, I may have to type that in. You've got it there. Okay, in the table that you've got, there's year, project A, and project B. And what you're going to do is use your computer for these two different options. And in project A, you have to spend $50,000, and what you're going to receive is a stream of $9,000 payments every year through 10. You still get the $9,000 in year 10, all the way through the end. Project B, in contrast, is that you have to pay $85,000, and then you get $14,000 during each of the years up until year 10. Okay, so what the handout says is, first of all, calculate the internal rate of return. And remember, the easy way to do that is with the function IRR. All you have to do is highlight the amounts inside of the IRR function, and it'll calculate the internal rate of return for both projects. And so part A is asking which project has the higher IRR, and now part B is asking which one has the highest present worth. And so in this example, the MAR, the minimum acceptable rate of return, is 4%. And so find the present worth of each project where you're discounting everything at 4% and finding the sum of the present value. And then what we're going to do is look at the comparison. You know, how do the IRRs compare to the present worths? I'm going to return the in-class exercises from last time, so grab yours out of the stack and pass it along. All right, so part A of the exercise asked us to calculate the IRR for each of the projects. So the way that we do that is just by the IRR function. It's pretty easy. So you just equals IRR, and then you highlight the entire cash flow range. What is the computer doing? Like, what's it looking for when we press enter? What is IRR? That's what it stands for, but what is it? Good. So it's the interest rate that brings balance. Remember the little picture of a balance from before? There we go. This is what IRR is. IRR is the balance between cash in and cash out when everything is taken to the present. So when I use the IRR function, what the computer is doing is it's saying, I'm going to discount all of these future amounts to year 0. And I'm going to use a bunch of different interest rates until I find the one that makes all of these inflows equal to the outflow at year 0. So in other words, it's solving for a present worth of 0. It's saying what interest rate would bring the present worth to 0. So when I press enter, just as quickly as we can see it updating, it's solved for whatever the internal rate of return is. And by definition, that means equilibrium between the inflows and the outflows. Okay, so if you were making the wrong comparison, like if you were applying bad judgment, you might say, well, it looks like project A is a better project. Because remember, what I told you is the rule, IRR should only be used for initial screening. Like, what is the tool actually for? It's for saying whether the project is acceptable or unacceptable. So both of these projects are acceptable. How do we know they're acceptable? What's the criteria for deciding whether a project is acceptable or unacceptable? Okay, the rate of return is higher than the MAR. So our minimum acceptable rate of return is 4%. And so both of them have an internal rate of return greater than the MAR. So both of them are potentially acceptable. That just means that if we had to go borrow the money someplace, like if we went to a bank and we're borrowing the money for 4%, we're still going to be able to cover that loan interest and still make extra profit on top of it. Both of them are acceptable, but it's a little bit, this is a great illustration of why you shouldn't use the internal rate of return to decide which one is best. You should only use it for initial screening. And the reason why is that what you really want to do is maximize your profits. You don't want to maximize some theoretical interest rate. You want to maximize how much money you put into your pocket. And between these two options, Project B is going to give you the greatest profits. The present worth method will never lead you astray. It will always identify which option is best. You can always count on the present worth method to tell you between alternatives which one should you choose. And what the present worth method tells us is that if we took out a loan at 4% in order to do Project B, we could pay off all of that loan interest and still, on top of it, make a present worth value of our profits would be $28,553. So if you discount every year the money that's left over after paying for the loan, you'd still have some money left over. And if you took all of those future payments to the present, then the value would be $28,553. In contrast, Project A isn't as attractive. If this is a mutually exclusive alternative, meaning you can only pick one of the two projects, you should choose Project B, not Project A. So here, in these cells, I use the NPV function. And just to remind you how to do that, you'd say equals NPV, and then you put in the interest rate, 4%. And now, I don't highlight all of the values. I have to skip over this $50,000 amount. I'm not going to include it inside the function. Why is that? Why do I need to skip over the 50,000? Yeah, it's already at the present. The only numbers that go inside the NPV function are future values. And so our future values are years 1 through 10. And then what I do is outside of that function, then I separately add on this amount that's already at year 0. Okay, so that's the NPV function. Now the other way I can do it, just to double check, is I could do the present value of each one of these amounts. And so it's equals PV, and it's a 4% interest rate, the N of whatever year we're on, skip over the payment field, the negative of the future value, and then for each one of these years, it's going to calculate the present value of this amount. So we're discounting 9,000 to year 0, discounting 9,000 in year 9 to year 0, and so on and so forth. And then we add up all of those amounts. So the NPV function kind of does this whole process internally without displaying it. When we use the NPV function, it's saying, I'm going to discount all of these amounts at 4%, and I know how many years based in which row it's on. So the one that's at the top of the list, I'm going to discount that 9,000 by 1 year. The next one, I'm going to discount whatever amount is there by 2 years, and so on. Okay, so the handout says which project should be selected. So I'm wondering, what did you write on that? And why? Has the highest present worth. Yeah, you're going to maximize your profits with option B. Now then it says there's a concept question. The concept question is, if you must borrow money at the MAR, explain what does the present worth represent. So I kind of already said it twice as we were talking through this solution. But who can rephrase this 28,553? What does that mean if you're borrowing money at the MAR?
How much you're in green. Sorry, after you get repaid your $85,000 that you initially invested.
Right. Yeah, so if you're borrowing money, you don't get to keep all of the profits. You have to give some of the profits to the bank. You have to give them not only the principal, but you have to also give them interest. And so once you've covered the principal that you borrowed, and once you also paid them the interest, then you're going to have a little bit money. You're going to have a little bit of money left over every year. And if you discount all of that leftover profits to year 0, then this is the total value of all of those annual profits taken back to year 0. It's critical that that makes sense to you. You know, we've already been through both the homework and in class the unrecovered investment balance, where you go through every year and you look at, you know, what's the payment amount, how much of that goes towards principal, how much of that goes towards interest. We could do the similar thing here. You know, for 4% and the initial purchase price, we could find out what the loan is supposed to be. In fact, let's just do that. Equals PMT. If we've got a 4% interest rate and it's for 10 years and the present value is negative 50,000, then it's 616. Oh, I put 5,000. 50,000. All right, so what that means is every year you're going to be giving the bank 6,164. And that goes towards the principal and the interest. So there's 9,000 left over. And what we want to do is we want to find out, you know, what's the present, I'm not left over. 9,000 is the total revenue. So your profits is going to be the revenue minus this amount that you're giving to the bank. And so the present value of the difference between the two is what's in each of these cells. And so the answer is you should choose option B. I think project is spelled with an E. That's better. Has anybody started on the homework already? Raise your hand if you've already started on the homework. That's ironic. The one guy who's not here today is the only one who started on homework. That's funny. He asked me some questions yesterday. There's an assignment on one of the problems has to do with the lottery. Nobody's seen that lottery problem yet? All right. Well, I'll give you a hint. I'm a little disappointed you haven't started on it yet, but I'll give you a hint. You need to write a cash flow diagram. And, yeah?
Is this homework 8?
Let's see. Did you already turn that lottery one in?
Yeah.
Okay. All right. So, yeah, I was wondering. Okay, that's the one that you turned in this morning. Okay, so for the lottery one, did you draw the cash flow diagram of the two options? I was surprised actually that I guess he wasn't working early, but at least he asked me before I left. I was surprised I didn't get more people asking about the difference between the two alternatives, because it was either that you're going to get $50 million now or $60 million spread out over a time period. Is that right? $3 million a year? Okay, so the option was that you were going to get $50 million now, $50 million, as a big lump sum, and then what you were going to do is you're going to turn right around and put it into the bank. And so you were going to deposit it into the bank, that $50 million that you earned, and then the bank account was going to pay you what, 2.5%? Okay, so you were going to earn an interest rate of 2.5%. Okay, that was the first option. And the second option was that you were going to take the $50 million that they gave you, and then you were going to give it essentially back to the lottery authority. And then they would give you a series of $3 million payments over the course of 19 additional years. Okay, so it was all the way through payment 19. And the reason why there weren't 20 of them is that you got one in year 0. So you gave them $50 million, the $50 million that you won, in exchange for every year getting $3 million. So this is the one exception of when you can compare internal rates of return, is because the amount is the same. You're going to either give $50 million to the bank, and that's what this one was. Option A was a bank, and option B was you're giving the money to the lottery. It's like you're making them a loan, because as soon as you have the winning number, they owe you $50 million, and they're hoping they don't have to pay it out. And they're going to kind of like entice you to say, well, we'll either give you $50 million now or $60 million spread out over time. And so you can compare internal rates of return when the original investment amount is the same. And so option B, essentially if this is the year and here's the amount, what we're doing in year 0 is it's the net difference between the inflow and the outflow. And so it's negative $47 million. And then each additional year is $3 million. Okay. And I asked you to calculate the internal rate of return for this one. So equals IRR, and we just go with all of these values. And it only turns out to be 2.01%. So you're better off going with the bank, who's paying 2.5%, than going with the lottery authority, because the effective interest rate that they're going to pay you is only 2.01%. But I wanted to emphasize that, you know, what it says in all of the things that we've learned so far is that internal rate of return is only for initial screening. So here on this slide from last time, we say, yes, compare an IRR against the MAR, but no, compare IRR of different projects to each other. The one little small asterisk, the one exception, is you can compare internal rates of return if the initial investment amount is the same. So that was the case in that lottery problem. You were essentially investing $50 million either in the bank or in the lottery authority, And so you can decide which one is best on the basis of the interest rates as long as the initial investment amount's the same. On today's in-class exercise, the original investment amounts weren't the same because Project B had a bigger initial cost than Project A. Okay, that's all I've got for you today. Remember that we're going to have a quiz in class next time. You should be prepared to use your computer for that quiz. There may be some non-computer questions as well, but please bring your laptop, and I will see you then.